Think the biggest banks always make the biggest IPOs succeed? Think again. It's one of the most pervasive myths on Wall Street, a siren song for founders on the cusp of going public. The allure is undeniable. Names like Goldman Sachs, Morgan Stanley, and JP Morgan are synonymous with financial power and prestige. Having them on your prospectus feels like a stamp of ultimate validation, a signal to the market that you've truly arrived. Founders often believe that securing a top-tier bank guarantees a flawless IPO, access to the best investors, and a soaring stock price. But this assumption, this belief that brand name equals best outcome, can be a catastrophic miscalculation, a mistake that can haunt a company for years. This brings us to the single most important decision in the entire IPO process: choosing your lead-left underwriter. The term lead-left comes from the literal placement of the bank's name on the cover of the IPO prospectus. Top left, the position of greatest prominence. This bank is the quarterback of your IPO. They don't just lend their name, they lead the syndicate of other banks. They are the primary architect of your company's valuation, and they spearhead the roadshow, telling your story to institutional investors around the world. If you're preparing to go public, the lead left shapes pricing, allocations, and the very narrative that sells your company to the world. Their influence is absolute, and that's why choosing the wrong lead left can be so devastating. It can cost you control, favorable terms, and even your long-term stock performance. Losing control can mean a bank pushing you to accept a lower valuation to guarantee a first-day pop for their preferred clients, leaving millions of your company's dollars on the table. Unfavorable terms can manifest as higher underwriting fees or restrictive lockup agreements. But the most damaging consequence is often the impact on long-term performance. A mismanaged IPO can result in your shares being allocated to flippers, investors who sell immediately for a quick profit, instead of stable, long-term holders. This creates immense volatility and can permanently damage your stock's reputation. So today I'll show you precisely why Goldman, Morgan, and JP Morgan aren't always the right choice, especially for a disruptive tech IPO. It's not about incompetence, it's about alignment and attention. For a bulge-bracket bank juggling multi-billion-dollar deals, your IPO might not command their A-team. You might get a junior team, less experienced and less connected. Their primary allegiance might be to their massive institutional clients, not to you. The unique story of your company can get lost, flattened into a generic template that fails to capture what makes you special. This is where the myth truly shatters, and where savvy founders can gain a critical edge. The lead left organizes the syndicate, pitches to investors, sets price ranges, and controls allocations. Their name appears top left on your prospectus, hence, lead left. Founders pick Goldman, Morgan, or JP Morgan for huge distribution networks, credibility, and research coverage. For large cross-border deals, these strengths matter. Choosing a bulge-bracket bank to lead your IPO seems like the default path to success. They offer a seal of approval, unparalleled research, and a global sales force. But this prestige comes with significant trade-offs that every founder needs to weigh carefully. The glossy brochures and impressive league tables don't tell the whole story. Behind the promise of a blockbuster IPO lies a complex set of compromises. First, let's talk about fees. The standard 7% spread is a well-entrenched Wall Street tradition. On a billion-dollar IPO, that's a staggering $70 million off the top. While this can be negotiated down for mega IPOs, for most companies, it's a hefty price to pay for distribution. This fee covers the bank's work in structuring the deal, marketing, and crucially, taking on the risk of underwriting. But it's a cost that directly impacts the capital you raise for your company's future growth. Beyond the fees, there's the critical issue of allocation bias. Bulge-bracket banks have a primary allegiance, their largest institutional clients. These are the massive pension funds, mutual funds, and hedge funds that do billions of dollars in business with the bank every year. To keep these clients happy, banks often prioritize them when allocating shares in a hot IPO. This is the friends of the firm phenomenon. This means your most loyal early investors, employees, and even dedicated retail customers who believe in your mission might get shut out. The bank's goal is to place shares with stable, long-term holders, but it's also to reward their biggest clients with access to a potentially lucrative first-day pop. This can lead to a feeling of betrayal among your earliest supporters, and can concentrate ownership in the hands of a few powerful funds who may not share your long-term vision. This brings us to the third trade-off: founder control. A bulge bracket bank's main objective is a successful IPO, which they often define as a significant first-day stock price increase. To engineer this pop, they may pressure you to price the IPO conservatively, meaning at a lower valuation than what you think your company is worth. This underpricing creates a direct transfer of wealth from your company's balance sheet to the bank's institutional clients who get the initial shares. It's a delicate balance, but founders can often feel like their long-term valuation goals are secondary to the bank's short-term transactional success. But there is an alternative. Boutique investment banks, like the legendary Allen & Company, operate on a different model. They don't have the same sprawling trading operations or the pressure to serve 1,000 institutional masters. Instead, they offer a more bespoke, high-touch service. They pride themselves on providing unbiased advice and cultivating a curated, targeted list of investors who genuinely understand your company's niche and are aligned for the long term. This is the fundamental trade-off: distribution versus fit. A bulge bracket bank offers unparalleled global scale. They can put your story in front of every significant fund on the planet. A boutique bank offers a tailored narrative. They invest senior-level attention to craft a sharper, more nuanced story that resonates with the investors, not just the biggest ones. They act more like a strategic partner than a sales agent. For massive, well-understood companies, the bulge bracket choice makes sense. Snowflake, a complex but powerful data platform, needed the credibility and reach of Goldman, Morgan, and JP Morgan to educate a vast investor base. Airbnb, a global consumer brand, chose Morgan Stanley and Goldman to manage their massive, highly anticipated public debut. DoorDash similarly relied on Goldman and JP Morgan to handle their scale. For them, the primary challenge was managing enormous demand, a task for which the bulge brackets are perfectly built. But what if you're not a household name? What if your story is more complex, your market more niche? For smaller companies or those with a disruptive but misunderstood business model, a boutique bank can be the superior choice. They can prevent your unique story from getting lost in a giant banking machine. They ensure the senior banker who pitched you is the one on the phone with key investors, telling your story with passion and precision. It's about finding a partner who will fight for your valuation and champion your vision, not just process your transaction. The choice of bank defines the narrative of your IPO, so choose the storyteller that best understands your book. So, how do you make the final call? Let's distill this complex decision into a practical framework. Think of it as your pre-flight checklist before the IPO journey. First, define your primary goals with absolute clarity. Are you optimizing for the highest possible valuation, or are you focused on building a stable, long-term shareholder base? These are often competing priorities, and your choice will dictate the type of bank and investor you need. Second, interrogate their allocation strategy. Ask for specific examples of how they allocated shares in past deals. Who gets the stock? Their top hedge fund clients who might flip it for a quick profit, or the Tier 1 long-only funds that will support you for years? This is non-negotiable. Third, demand to see their target investor lists and scrutinize them. Do they truly have access to the key decision-makers at the funds you want on your cap table? Cross-reference this with their research analyst's reputation. Strong analyst coverage is your post-IPO marketing engine, ensuring your story continues to be told long after the bell rings. Now, let's talk about the warning signs. These are the red flags that should make you walk away, no matter how prestigious the bank's name is. The biggest one, vagueness on allocation. If a banker can't give you a clear answer on how they'll place your stock, it means they're prioritizing their relationships over your company's future. Another major red flag is a lack of recent and relevant IPO experience. The market changes in months, not years. Ask for deals they've led in the last 12 to 18 months in your specific sector. And finally, the most seductive and dangerous red flag: guaranteed aftermarket promises. If any banker tells you they can guarantee a 20% pop on day one, they are either lying or incompetent. No one can predict the market. This is a sales tactic that often signals a bank that will underprice your deal just to create a splashy headline. Ultimately, the choice between a bulge bracket bank and a specialized boutique isn't about good versus bad, it's about fit. A global bank brings unparalleled distribution and brand credibility. For a mega deal like Snowflake's IPO, this is essential. But as a smaller company, you risk being a low priority. Getting the B team after the bake-off is one. A boutique bank, on the other hand, might offer you direct access to their most senior partners. They live and breathe your industry and can tell your story with more nuance. The trade-off might be a narrower distribution network. Your decision should be driven by your strategy, not by a logo on a pitch deck. Match the bank's core strengths to your company's specific needs. Choosing your banking partner is just the first step. The real work begins when you start negotiating the terms of the deal. If you want to master that process, make sure you subscribe. In our upcoming videos, we'll be doing deep dives on decoding the underwriting agreement, breaking down the economics of the green shoe option, and providing a founder's guide to navigating the S1 drafting process. You don't want to miss it.